Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimers, I'll just run through some of the key objectives of this webinar. Markets we think are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal as well is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way, and we'll be more than happy to answer them as soon as possible, or at least after the webinar finishes. Okay, it's Wednesday, 4th of December. It's just after 11 a.m. in London, so let's get to it. Firstly, I'll just run through what we hope to get through in the next 30 minutes or so. We'll run through all the main events that we've been seeing in markets recently. So we'll review some of last week's data out of the Eurozone, the inflation data. We'll look at the RBNZ rate decision and the US data from last week, before then previewing the main event of this week, of course, which is non-farm payrolls on Friday, key monthly job report from the US, which really will determine, you would think, what the Federal Reserve does on the 18th of December in a couple of weeks' time. So firstly, I'll just check out how markets are shaping up currently. We've just had some comments from Governor, Bank of England Governor Bailey, actually, who moved sterling a little bit. We saw a sell-off, a small sell-off in sterling, actually, after he said that he expects 4 rate cuts next year if things pan out as they expect. That is actually what the markets were or have been predicting as well, pretty much priced in. So even though we saw a sort of initial sell-off in sterling, that has come back now, and cable is pretty much flat on the day or so. Otherwise, currency-wise, the Aussie dollar is much weaker after soft Q3 GDP data. That came out overnight, really, and sort of brought forward the prospects of a rate cut by the RBA. We'll look at that shortly, actually, that data. VIX is trending lower for volatility. The Wall Street fear gauge really and focuses on Fed Chair Powell's speech later today, and there is some labor market data as well. The ADP really not a great forerunner for NFP, but there is the ISM services data out of the US as well, which will be looked at, and especially the employment component. Crude, that jumped on Iran sanctions and OPEC plus production curb speculation, and then equities. Yeah, just rising in Europe. Asia pretty subdued after the volatility around Korea. That's calmed down a bit now, really. And futures in the US looking pretty positive, actually. On that, if we just check out a couple of charts, and yes, US indices basically. Yeah, one way at the moment, really, post-election, and really for most of this year, of course. US outperforming everywhere else at the moment. The wider indices, the S&P and the Dow both reached record highs. Sorry, the S&P and the Nasdaq both reached record highs yesterday. Friday, the S&P and Dow reached record highs. And yeah, tech is leading the way, really. Semiconductors led the way on Friday, and then yesterday we saw Meta lead the gains, up 3.5%, and then overnight, actually, we've seen Salesforce up around 10% last time I looked, after hours, after posting better than expected earnings. Interesting, actually, when you dive into some of the detail, cyclicals are still outperforming defensives, and that's further widening the already historically significant outperformance we've seen over the last few years, actually. As I say, the VIX has ticked lower from already low levels, and that really reflects this sort of benign macro environment and optimism really surrounding the new Trump US administration, of course, encouraging really investors to take on more risks, and that is then leading to these all-time highs that we're seeing pretty much day on day in the US. Just looking back actually for November, the S&P posted its best month since February, up 5.6%, and the Dow actually surged 7.5%, while the Nasdaq actually lagged slightly, just climbing 4.9% just on the month alone in November, really reflecting, as I say, all that optimism about Trump, pro-business policies. And yes, and now sort of we did sort of pause slightly with a reflection on what that will mean, but stocks have gone again and making fresh highs. So not too much to show you really about some of the charts. If I do just grab, that's the S&P 500, the benchmark. Nasdaq made fresh highs, and you can see really nice positive move higher, really breaking that 21,182 level from mid-November. So that looks good for more gains. And then the Dow as well, futures are up nearly 0.5% now, above 45,000. This just looks like bullish consolidation, really. So healthy pause after breaking to new highs. You can see just slightly overbought on the RSI, and then just again, if we look at the futures, you'll probably see a break higher, and you do, and probably we will be breaking these previous highs at 45,171 in due course. I should say, just on a couple of things, tariff turmoil sort of has hit markets, well, briefly, and over the course of the last couple of weeks, of course. Previously, we had Trump threatening 25% tariffs on Canada and Mexico on day one of his new administration in January, and then he threatened a further 10% tariff on all products from China. That did send CAD and the Mexican peso sharply lower, with dollar CAD actually running up to 140, 150, so multi-year highs. Interesting though, we do give a big caveat to this. Trump then actually tweeted that he's had a call with the Mexican president, and she was sort of aware of worries and really wanted to ease those issues and tensions, and Trump called that a success, which of course we know means he goes in very hard with strong headlines and then sort of meets in the middle, and that we are basing a lot of our trades on, with fading some of these initial moves. One other area we should mention as well briefly before we get into last week's main events, the French budget battle, really. So ongoing headlines about the collapse of the government in France potentially happening tonight. We've had French bond risk really rising to levels last seen during the euro area debt crisis in 2012, basically with this proposed standoff in the budget. Real a storm, I think, is what PM Barnier called it in financial markets. Potentially, should that happen, and it is likely it will happen. So we're just waiting to see now what happens next. I know that President Macron has kind of eased tension slightly, expressing confidence in surviving a no confidence vote, but certainly is not what the euro needs at this time. Evidently, with stagnation on the economy, of course, tariffs from Trump potentially happening in the new year, and then of course the ongoing Ukraine conflict. Okay, let's go to last week's main events. Firstly, just got a graphic with just the main data that you can see from the Eurozone inflation data. So inflation really picked up pace in November, actually, but less than expected. So the headline increased 2.3% from 2% from October. That was in line with expectations. But the core, that was unchanged at 2.7%, expected 2.8%. So the headline, that ticked up really because of base effects, and some upward pressure from input prices is starting to become more pressing. So that's commodity prices, food, natural gas have been on the rise, although so far that impact has been relatively modest. The big weakening of the euro against the dollar does add actually to modest upward pressure as well on inflation at the moment. But then you've got the flip side of economic activity being pretty weak, and then wage growth, which has been hotter, of course, through the third quarter. That is probably now easing with the labour market softening as well. That will be a big factor for inflation going forward, we would think, in the new year. Softer demand, of course, if that remains weak, then should bring wages lower, should bring services inflation lower as well. And that is something that ECB policy makers have certainly been concerned with over the previous half year or so. Core inflation, actually, just to mention, because that's obviously the key number for policymakers, that has been stuck at 2.7% now for 3 months in a row. But as I say, again, potential easing should be expected in the coming months, mainly from that continued weak demand and then easing services inflation. And that did tick a touch lower, you can see, from 4% to 3.9%. If we just check out euro dollar actually now, good time to do that. Which is here. You can just see, yeah, we spiked down to 103.31 a couple of Fridays ago, just bounced back to the first sort of fib level, and then we've just moved down off that again. We've still got the 104.48 level, which is that long-term low from October last year. You can see it there. So we're just hovering above that at the moment. We probably need to get back above the, well, it's certainly this grey line, which is the 21-day moving average at 105.69, and probably above this high from the end of November at 105.96. So 106 area is certainly strong resistance. Otherwise, 104.48 and then 103.31 to the downside in euro dollar. The US, that did have core PCE data, the Fed's favored inflation gauge, basically a wider sort of measure than the CPI basket. That rose 2.3% in October, which was expected, and the core number, that's the core PCE number, that's the key number for the Fed. That did accelerate, but was also in line with expectations to 2.8%. Overall then, no real worries really, and not a massive market reaction to that. We do get another CPI data print next week actually, and PPI next week as well. That's after, of course, non-farm payrolls, and before then the Fed meeting, which is, as I say, in a couple of weeks' time. One other event from last week was the RBNZ meeting. They cut rates by 50 basis points, taking the OCR, the overnight cash rate, down to 4.25%. That was as expected, really. Growth risks start to compound, though. Governor Orr, he noted that the path ahead will be front-loaded, with another 50 basis point cut likely in February if current trends persist. The projected track actually for the OCR was also revised down, so that's seen reaching 3.5% or so by the end of next year, and that's actually 30 basis points lower than August. All this accompanied by expectations for softer inflation in the near term, and also actually a downward revision for GDP. Growth now expected 2.3% versus 3.3% previously. That's for next year. Kiwi then struggling really, similar to the Aussie actually, struggling today for sure. You can just see if we pull this back, we're at sort of key sort of support zone really, with that spike low obviously on the radar for bears really. That's at 57.96 you can see, but there is decent support around this level. So if we do break down, and 57.96 is the first level, before then we get to this low from October last year, spot 57.73. That's Kiwi dollar. Just some other data, obviously I mentioned briefly at the top of the webinar, was the Aussie Q3 GDP data. That came in sluggish, rising only 0.3% against a 0.5% forecast, really as government spending offset weak exports and consumer demand. The year-on-year rise actually of 0.8% was below estimates of 1.1, and that led traders really to change their bets really on the first RBA interest rate cut. That's now seen in April. Now fully priced actually for April, before the GDP data was given around 60% odds. So yes, if we just look at the Aussie, you can see that's collapsed today, down over 1%, 1.15%, and breaking to new lows for the move really. And all we've got left really is these spike lows from the start of August at 63.47, just before that 63.62. To look at. Otherwise, then we're down to these levels from October last year, again at 62.70. But it does look like a really strong break to the downside in the Aussie now. Really because an RBA first rate cut is kind of on the horizon. As I say, in April is now expected. Okay, well, let's now go to this week's main events. In fact, just before I do that, I've just got a chart with those PCE US inflation numbers along with the CPI, and just ticking up slightly, but nothing major to worry about. Of course, Trump's policies are seen as inflationary, so that is a concern going forward, but just really depends on the tariffs especially, and what President Trump's pick for Treasury Secretary Scott Bessent, what he does, as his views are known to be one of, I think, the best describes a tariff gradualism, as opposed to Trump's more vocal, more vocal slant on it. So tariff gradualism means potentially, yes, less inflation further down the track, but we shall see. Okay, non-farm payrolls, of course, on Friday, major report, major risk event for markets. Consensus, that looks for around 200, just gone up actually, 210 or so now, expected on the headline. The range was 155 to 270. That 270 probably has risen now. That follows, of course, the very small 12,000 print in October. But of course, that was down to those hurricanes, Milton and Ellen, and also, of course, the Boeing strike, which really disrupted the NFP headline number. And we are expecting a big bounce, therefore, to the economy this time around. Interesting, I think the state data for October shows 109,000 as a sort of base for the November report, before then considering any payroll growth. So essentially that is 44,000 striking workers returning, and then around, economists reckon, 65,000 who were not counted due to the hurricanes, which will be included, of course, in the November data. That gives us a number around 200,000 or so, 210, which is a consensus estimate at the moment. The jobless rate, that's seen at 4.1%, just still below that September Fed forecast of 4.4%, so stronger really. The employment picture there, and then the pace of average hourly earnings, that's seen easing a touch to 0.3%. Nothing major there to consider. Other jobs data for your guide, initial jobless claims for the week that coincides actually with the BLS survey window, that eased actually to 215,000 heading into the November data, but continuing claims actually picked up, and it's really that latter number, continuing claims, which kind of broadly supports the idea that the flow of initial claims still is high enough for unemployment to continue to rise. But the bottom line is it's non-farm payroll, and anybody saying they for sure know what's going to happen will no doubt become a cropper, because it's very tough to obviously forecast these numbers with any certainty. Just interesting on the sort of hurricane rebound that we've seen in the past. I know that sometimes it can take a couple of months to feed properly into the data, so it's not just a 1 month rebound, but we shall see, of course, going forward. We do get yes, the next data report, the non-farm payroll report, sorry, will be, of course, the first Friday in January. That will then be December's data. I'm just checking, actually, will be the second Friday, I'm pretty sure, in January. So not the third, I'm pretty sure, but it will be the 10th of January for the next non-farm payroll report after this one. For the Fed then, well, their recent meeting minutes actually gave really no explicit indication on whether the bank would pause on rates or proceed with a 25 basis point cut. Money markets at the moment, they have pretty certain that a cut will happen, 74%, so sort of 26%, oops, a little typo in there, 26% chance of a pause actually at the December meeting. Goes without saying, if we get a decent print, say 240, 250, and the unemployment rate unchanged, then potentially these odds swing fairly pretty much to, say, 50-50 potentially. Depending on the size of that print, obviously, and if that jobless rate is unchanged. Kind of sweet spot would probably be 170 to 200, and a sort of small change in the unemployment rate. That would probably keep a December rate cut in play, but also, of course, signals relatively healthy job creation. And the downside, really, then you kind of think a truly weak NFP, so below 100 or so, plus a higher unemployment rate, that would possibly derail the equity move that we're seeing, of course, with these all-time highs. Really, you want to be checking out the 10-year yield and dollar yen, especially, is always obviously correlated highly to the 10-year yield, and then obviously to this data. But any obviously majors will dollar majors will move sharply on this data. Okay, I'll just run through briefly as well a couple of other data points. We do get ISM services today. That's the US ISM services. Might have some focus on it due to the employment data in that. For the headline, expectations are for it to slip slightly to 55.5 from 56.0 in October. That October print actually was more than a 2-year high, but generally services activity does remain firmly in expansionary territory, and employment also is strengthening. And just a quick one on that, we did actually get as well the ISM manufacturing data on Monday. That came in slightly above expectations, actually still below 50, so came in at 48.4, better than the 47.5 expected and the prior 46.5. But notably, actually, just in the detail, new orders rebounded to expansionary territory, so above 50. And really the uptick kind of confirmed the positive signal seen in earlier PMI data. So employment improved, and actually price pressures appear to be cooling, and that is really a sort of Goldilocks report, really, which was relatively positive and backing up the decent standing, really, of the US economy. I've just got the DXY chart here that you can see. So this is the dollar index, of course, which has 6 of the US major trading partners, really, with the euro being by far the biggest weighting in this index, about 56% or so. If you turned it on its head, as we showed you, you would get euro dollar, which is there, and the spike lower. So you've got a spike higher, which was up at 108.07. So you can just see a slight pullback, really, just below that previous April high. That's at 106.51, and we're just above that now. So next level for us will be that high from October last year, 107.34, and then obviously the spike high at 108.07. That is the dollar index. Finally, we'll just touch upon the Canadian jobs data out at the same time, actually on Friday, as the non-farm payroll report. Analysts forecasting around 20,000 jobs to be added, so slightly more than the prior 14,500, and the unemployment rate seen around 6.4%. The labour market has been pretty resilient all year long, actually, in Canada. Over 270,000 jobs created so far. And the data will likely shape, of course, those expectations for next week's Bank of Canada meeting. Money market expectations are leaning towards a 25 basis point cut following the 50 basis point rate reduction at the last meeting, actually. Interesting, actually, traders were kind of split between a 25 and a 50 basis point rate cut. But then we had a slight resurgence in inflation, which has seen that chance of a 50 basis point cut really revert to around 20% or so. Of course, a soft labour market report would obviously increase the chances of that 50 basis point cut again happening soon. Dollar CAD, CAD is struggling, of course, with the BOC being fairly dovish. And also potentially these tariff threats, which of course Trump is making so far. Yeah, we've got the spike high at 141.77, multi-year high. If we just pull that back. You can see we haven't seen these levels since April 2020, 141.77. That's on the weekly chart. So yeah, holding around the 21-day moving average, that's the gray line, offered fairly decent support actually. So that's at 139.92 below. Otherwise, really, yeah, near-term highs at 141.05, and then the spike high at 141.77. Okay, short and sweet today. Covered quite a lot, of course. I don't see any questions at the moment, so that is all good. Really do appreciate you being on the call, of course, on the webinar, and we will speak to you in a couple of weeks and really review and preview the Fed meeting and also a load of other central bank meetings actually coming up. We've got the RBA, the Bank of Canada, the SNB, the ECB next week, and then the following week we have the Fed and the Bank of England and the Bank of Japan, I think. So central bank fest really in the coming weeks, and we will preview and review all of those in a couple of weeks' time. Great to have you on a call, as I say, and we will speak to you in a couple of weeks. Take care.